Hey everyone, welcome back to Money Empire, where we break down everything happening in the financial world in a way that's easy to understand. Let me ask you this, are you ready for one of the most important weeks in the stock market this year? Because next week, everything could change. Investors are watching closely as the Federal Reserve gets set to make a critical interest rate decision on September 17th. This is not just another Fed meeting. The decision could trigger major market movements, impact your portfolio, and even affect your long-term financial strategy. Today, we're going to break down every possible scenario so you can be prepared and make smart investing choices. The Federal Reserve meeting is especially important because it will give clear signals about the future of U.S. interest rates. If the Fed decides to cut rates, it's likely to inject optimism into the stock market. Conversely, if rates stay the same or rise, we could see a short-term pullback in stocks, especially in tech and growth sectors. But it's not just about the U.S. rates. Global central banks, including the European Central Bank and the Bank of England, have upcoming policy meetings that influence investor sentiment worldwide. These decisions could ripple across international markets, affecting stocks, bonds, and commodities. Being aware of these dates helps you anticipate volatility. Let's talk about September 16th and 17th. Those 2 days are critical because the Federal Open Market Committee, or FOMC, will announce its decision. Analysts and traders are speculating heavily about whether the Fed will implement a 0.25% rate cut, keep rates steady, or hint at larger adjustments in the months ahead. Markets often react not only to the action itself but also to the language used in the announcement. Even subtle comments about future inflation, employment trends, or economic growth can drive big swings in stock prices. Preparing ahead of time is essential to protect your investments and seize potential opportunities. On the European side, the ECB is conducting monetary policy meetings right after the Fed's decision. The Bank of England's MPC decision comes shortly after that, on September 18th. These global decisions influence expectations for interest rates in Europe and the UK. For U.S. investors, this is critical because international market trends affect multinational companies and sectors like tech, industrials, and finance. A strong or weak signal from the ECB or BOE can either amplify or counteract U.S. market movements. Watching these dates carefully gives you insight into how global trends might influence the U.S. economy and your portfolio. Looking ahead to October, there are several key economic events that every investor should note. On October 3rd, the U.S. will release its non-farm payrolls data, which measures employment growth. Strong employment numbers usually signal a healthy economy and could reduce the likelihood of additional rate cuts. Conversely, weaker job growth may increase the odds of easing monetary policy. Then, on October 15th, the Consumer Price Index report will give us the latest inflation data. This is critical because inflation drives the Fed's rate decisions. At the end of October, the FOMC meets again on October 28th and 29th, potentially adjusting rates further or signaling future economic policies. Now, let's address a question that came up in the comments from last week. One viewer asked about selling individual stocks like Google and Tesla while holding ETFs like VU and QQQM. This is a smart question, especially in light of potential market volatility. Individual stocks are often more volatile than broad market ETFs. If the Fed cuts rates, the stock market could rise, but highly valued tech stocks might see sharp short-term swings. Balancing your portfolio with mostly ETFs and a smaller portion in individual stocks can help reduce stress while still giving you exposure to growth opportunities. If your portfolio is heavily weighted in high-flying tech stocks, you might feel anxious about a potential market pullback. That's why many advisors recommend keeping 80 to 90% of your portfolio in broad ETFs and 10 to 20% in individual stocks. This approach allows you to participate in potential growth while protecting your portfolio from excessive volatility. If you're worried about a short-term dip, consider locking in profits on some of your high-performing stocks. Taking partial profits can give you more flexibility to reinvest in safer assets or opportunities that may emerge from market volatility. Let's dig into what could happen if the Fed does implement a rate cut. Generally, lower interest rates make borrowing cheaper, which stimulates economic activity. Growth stocks, particularly in tech, semiconductors, and software, could see a strong rally. Dividend-heavy sectors like utilities and REITs may also benefit as investors search for yield. However, banks and financial companies could initially decline because lower rates reduce profit margins on loans. Bonds would also see changes, with Treasury yields likely falling, particularly short-term rates, which could further support equities but also signal potential recession worries if rates drop too quickly. The US dollar is also expected to react to rate changes. Typically, a rate cut weakens the dollar, which can be positive for exporters and multinational companies. A weaker dollar also tends to push commodities like gold and oil higher. Gold benefits because the opportunity cost of holding it decreases when rates fall. Oil may rise if the dollar weakens and demand remains steady, but global slowdown fears could offset some of this increase. Understanding these relationships helps investors anticipate how different asset classes may respond to Fed policy changes. History gives us some clues about what could happen next week. Mid-cycle rate cuts, like those in the 1990s and 2019, tended to drive strong stock rallies because the economy was still expanding. Recessionary cuts, like those in 2001, 2007, and 2008, often led to initial stock gains followed by declines as earnings fell. That's why context is critical. Investors should not assume a rate cut automatically guarantees long-term stock growth. Market sentiment, valuations, and the underlying health of the economy all play a role in how equities respond after policy changes. Currently, the market has largely priced in a potential rate cut. This means much of the expected impact may already be reflected in stock prices. If the Fed cuts rates as expected, the stock market might not jump dramatically because expectations are already baked in. However, if the Fed surprises investors by keeping rates steady, we could see a sharp market dip. Understanding that expectations drive market reactions can help investors stay calm and avoid emotional decision-making during volatile periods. Given all this, how should investors approach their portfolios this week? A balanced strategy is key. Stick to your long-term plan with broad ETFs and diversified holdings. Dollar-cost averaging remains a reliable approach, allowing you to invest consistently without trying to time the market perfectly. If you notice temporary dips in strong stocks that you have researched, this could be an opportunity to buy at slightly lower prices. Staying disciplined and focused on quality investments can help you ride out short-term volatility while staying on track for long-term growth. One area gaining attention is gold. Many investors are increasing their exposure because inflation may rise in the coming years. Gold acts as a hedge against currency weakness and economic uncertainty. Similarly, Bitcoin and other digital assets have been attracting interest as alternative stores of value. Adding small, well-researched positions in these assets can help diversify your portfolio against potential inflationary pressures. Always remember to do your research and avoid making impulsive decisions based solely on headlines or market hype. Another strategy is to monitor undervalued companies or ETFs that have lagged despite strong fundamentals. For example, companies like Berkshire Hathaway may temporarily underperform while broader markets rally. This could create buying opportunities for patient investors. Keep an eye on sectors that historically perform well during uncertainty, such as consumer staples or healthcare. A diversified approach, combining both growth and defensive assets, can help you navigate potentially volatile weeks like the one ahead. It's also worth noting that global economic trends matter. Weak GDP growth in Europe or stagnating production in the UK could influence US market sentiment. Investors need to be aware of how international markets interact with US equities, especially for multinational companies with overseas exposure. Understanding these global connections helps you anticipate potential risks and adjust your strategy accordingly, rather than reacting solely to domestic headlines. Volatility is expected in the coming week, but that doesn't mean you need to panic. Having a plan, understanding market drivers, and sticking to a balanced portfolio are your best defenses. Avoid making rash decisions based on fear or short-term price movements. Remember, successful investing is about managing risk and staying disciplined over time. The events of next week are important, but they are just one piece of a larger economic picture. Finally, keep an eye on upcoming October events. The non-farm payrolls, CPI report, and the next FOMC meeting will provide further clarity on economic trends and potential rate adjustments. Preparing in advance for these dates ensures you are not caught off guard and allows you to make strategic investment moves. Staying informed and calm in volatile times is what separates successful investors from those who react emotionally. In conclusion, next week's Federal Reserve decision could shape market trends, but it's only one part of the broader financial landscape. Keep your portfolio diversified, focus on long-term goals, and pay attention to global economic signals. Take profits when necessary, consider hedges like gold, and continue investing in quality ETFs and stocks. Staying informed, disciplined, and prepared is the key to navigating uncertainty and making the most of market opportunities.